I'm 92.90, 10 by 10. Yours.
Mine.
99 at the buck. Welcome to the OpenYield Markets Podcast with your host, Mark Hebert.
Welcome back to a new episode of OpenYield Markets with Mark podcast. We are very thrilled to have our guest today. I call him the Nomad of Fixed Income. He goes wherever there is food and shelter in this market. The CIO of SWBC, Chris Brigati, is on with us today. We're very thrilled. He and I both overlapped at Morgan Stanley, though in different roles, and he's been a little bit of everywhere. We're fortunate to have him today because usually he's on CNBC and Bloomberg, and today we get him from Conference Room Double Z. But Chris, thanks for being on the show today to talk all things markets.
Yeah, thanks a lot. Glad to be here and looking forward to this.
Yeah, so I guess we should start with what's going on in the overall market, the macro. It's been anything but quiet, even though we've seemed to have been drifting up for the last, since April, really, since Liberation Day. But there's been some tremors, there's been some cracks, there's been things to talk about. What do you think about the backdrop right now? Where's your head at? And what about where we've been the last couple months and what you kind of think about the next couple months?
You know, when I think back to where we've been recently, and really it stems back to the early part of this year, the word uncertainty comes up a lot. We've had things happen that we don't expect, that roil the markets, that rattle the markets, that when something gets resolved, suddenly everything's great again. And so the uncertainty is really out there constantly, it seems, and that's not going away anytime soon, it seems. When I'm talking about what's going on with President Trump and some of his initiatives, suddenly we're back into a trade war with China. Then we could have that resolved, and then we can be back into a trade war with Canada. Who knows what's coming next? But all these uncertainties are really the challenge for the market. Fortunately, I think we've gotten through them pretty good, but I'm waiting for that next shoe to drop.
Yeah, so it's one of these things where geopolitical risk is heightened. You know, every single time we've had anything that's made the market sell off, we've almost bought the dip the next day since Liberation Day, almost in a straight line up. And do you think that this can change, or do you think that, the complacency in the market is here to stay, passive markets, inflows, all these things are all pretty strong still? And as long as Trump's under the head of the administration, we're in an okay place.
I think that I liken it to a little bit of a rubber band stretching, and there's elasticity in that for a period of time until it does suddenly snap. And the longer it goes and the further it gets, the more it's going to hurt when it does snap. And that's, to me, the concern. So do I think this can continue for a while? Yes, I do. Do I think it's going to hurt when it does rebound or snap back the other way? Yeah, I think it will. So it's a matter of how and when that happens and what is the catalyst. And like you said, we're buying a lot of dips in here consistently, and that's been a good trade to be able to get in and out of. But in the long run, some point that's going to not work.
So you're saying, or you're calling for some sort of real correction at some point, short to medium term, medium to long term, whatever it is, but something's coming. You can't have this all tides lift everything, every asset class forever.
Exactly. And I think we'll get into some of that probably down the road in this conversation,
Yeah.
but I definitely see that.
I want to talk a little bit more about the Fed and Powell, et cetera, a little bit later on. But I do want to talk a little bit about inflation now as we're talking about the macro picture. Inflation has come in, but it seems like it's leveling, if not even kind of re-inflating at these 3% levels or whatever it is, high twos, threes. And again, we'll talk about the Fed later. With tariffs, with everything that's going on, with the inflation running a little hot, like what's the game plan to get inflation down to 2%, or is that a thing of the past?
I think here's my out of the box odd prediction, and I put a low probability in this, but I think the Fed might change their tune in terms of getting away from the long-term 2% inflation target, and they might go to more of a range target and kind of give themselves a little bit more flexibility. And I think that's a move that they may make. But in the grand scheme of things, I don't think inflation is going away.
So flexibility takes away credibility, right? The mandate changes because you couldn't achieve your goal.
Correct. But they're already struggling with that credibility right now, right?
That's like when, I used to be a free throw shooter, a pretty good one, but if I couldn't get to 85, I'd just say, hey, 80 is my new goal.
Yeah.
Then eventually you say 50% is your new goal, though, but then you're not very good at it.
Then you're Shaq.
Exactly. Then you're Shaq, and you're not a good free throw shooter. So I'm wondering if the credibility, eventually, though, you can't have an economy running hot vis-a-vis where we want to be and stated goals, especially with the dual mandate of employment. Which leads me to that question. The labor market seems to be cooling a little bit, but how much cushion do we have? Historically, we're still at very low unemployment rate. How much cushion do we really have? Is employment to you a real concern, or do we have a little room there?
It's becoming a bigger concern, and one of the things that I've noticed and I'm thoughtful of lately is we're dealing with something we've never dealt with regard to the migration picture in the U.S., and that is uncharted territory for us. So the unemployment rate is low, but we're seeing this uptick in things that are negative for the economy and negative for the employment situation, and those haven't fed into the broader unemployment rate yet, which is the metric the Fed has always watched historically. So now we're trying to figure out what's the new normal.
Which would talk a little bit about how the Fed, in a sense, has almost pivoted twice here in the last 3 or 4 months, right?
Yeah.
I guess what we're going to do, actually, we're going to take the Fed, which I was going to have later on the show. We're just going to put it now. So Powell's kind of pivoted twice here in the last 3 or 4 months,
Yep.
right? Jackson Hole versus what he said at the last Fed meeting. Do you think the pivot is warranted? Do you think he's a little worried about both sides of the mandate right now? And let's be honest, interest rates are hovering at 4%. Fed funds are still, I believe, higher than where they were when we first started cutting rates. We have a little bit of a pickle here.
We do, and the challenge is how does the Fed manage through this? And to your point about credibility, that's on the docket now. Flip flopping is never a good policy to have. And it was interesting. Prior to Jackson Hole, I was very thoughtful that when they were talking, when any Fed chairperson was talking, including Powell, they were very focused on inflation. That was said so many times throughout every press conference, for every discussion they would have. And suddenly Jackson Hole happened and that started to flip. And once I heard that, I said, this is going to change the game a little bit. And it did for a period of time until this latest FOMC meeting and Chair Powell's presser. So when he changed it again, now to me, that indecisiveness is not a great thing for the Fed to have. And I'm a little bit worried.
You have indecisiveness, and you also have a lot of dissent within the Fed, right? There's definitely a time right now where people in that room have varying opinions and very strong opinions. This is probably some of the strongest language I've heard actually out of Powell in his prepared remarks, not in Q&A, in a long time. Seems to me like there's some real trouble within brewing, and people are really concerned.
And I think they should be. I mean, when you have that much division within the Fed, it's good when it can be managed and the process is understood and they're working through a problem, et cetera. But it seems to be kind of creating a little bit more angst within that room, so to speak. And that's what I'm concerned about.
Yeah, it's going to be really fun to see how that plays out. So far, people still act like nothing's happening, but that only lasts so long usually. Let's take a small pivot into your bread and butter historically, and something I've been learning a lot more as I've been in this role here, and the muni market. So the muni market for 2025 was trading relatively cheap, not in fact relatively, extremely cheap versus corporate market for a period of time. It's since caught up a little bit. What's your take on munis? They seem like they've been pretty resilient and strong for the last couple of months. Where are we in munis, and what do you think?
I think the municipal market was slated for some opportunity this year, namely because I did expect rather the issuance to really uptick, and it has. So we're on pace for somewhere around, my target was somewhere around 550 million in new issuance this year. We're probably getting pretty close to hitting that. So that's a positive. The other positive has been demand has been very robust. I mean, we're at historically absolute attractive yields on an absolute basis. That's bringing a lot of buyers into the market. Now, they're not crossover buyers, but they're buyers that have probably not been as involved in the past as they would have been in the past. So I'm looking forward to the opportunity for the municipal market to continue this kind of wave of feeling good.
So wave of feeling good leads me to my next question, though. Munis have been relatively strong since COVID and inflation, and all these municipalities got a wave of inflows, if you will. Are there cracks, and I'll talk about Brightline, right? Or are there other cracks that you see forming in munis where maybe the cash is running out, refis are coming at higher all-in yields for them, or are we okay?
I think we're okay, but there are cracks starting to appear. And I think one of the things you'll look at is rainy day funds. It's different for every entity almost. They all have a different name for it. But rainy day funds are kind of running a little drier now. And that's a challenge for them going forward when we're expecting to have some difficulties with the economy and some difficulties for the constituency base within the municipality. So when I'm looking at the opportunity set and I'm thoughtful about where we can go from here for the municipal space, I'm thoughtful of that. And my concern is really where can they go and how can they get out of this rut of not having enough rainy day funds. There's no urgent need right now, but when you don't have that to fall back on, it does raise issues.
And tax equivalent yields, to your point, are historically high,
Yep.
right? Very attractive from an all-in yield perspective, tax equivalent. And I was looking at some paper a couple weeks ago that was 8, 9.5% IG tax equivalent yields, which kind of got my eyes open to maybe putting some in my own PA. My question to you more is, where does this go and how long can this persist? Right? If you have these high TEYs for so long, the next bogey might need to be higher for people to invest in vis-a-vis other asset classes. So do we really catch up, or are we in this somewhat higher for longer muni yield environment?
I think we're in a little bit higher for longer muni yield environment on a relative basis, simply because of the richness of the other asset classes as well. We can probably get in that, but down the road, when you're talking about corporates being relatively tight credit spreads, that takes some of the wind out of the sails of that trade, and that forces people, or incentivizes at the very least, people to look at the municipal market, and they have been. And rich people do not like taxes. So if there's a way they can avoid them, they're going to do it. And munis are an easy way.
Yeah, they sure are. We have a Democratic socialist elected mayor. What do you think is the implications for municipal paper in the area, in New York City, New York State? And do you think this is a structural shift for politics, or do you think this is very concerted here to this local jurisdiction?
Well, I think there's a broader structural shift throughout the country. We saw a ringing endorsement for Democrats, and a lot of that had to do, in my opinion, with the fact that we do have the government shutdown, and the office in power is going to get the blame for that. And clearly, the Trump administration and the Republicans in Congress and the Senate have taken the blame for that based upon these election results. But within the New York City construct and within what's going on with Mamdani and how they're going to work through this, I do see the fact that they could expect to have higher issuance of municipal debt, which should cheapen up the debt overall. I'm not going to say it's going to gap out by 50 basis points or anything crazy, but it could be a slight cheapening of the debt because of concerns about a potential new issuance and supply demand dynamics come to play. It's that simple. So I do expect a little bit of a challenge there and a little bit of widening.
And he's still going to need help from Albany to get a lot of this stuff done too. This is not something where he comes in with all these grandiose plans and they're all going to get done, right?
Right.
It's kind of almost like every politician, you aim for, you campaign 100%. If you get done 40, you probably feel pretty good about it. But he still has a lot of work ahead of him to get any of these things done anyways.
He does have a lot of work to do, and it's going to be a challenge. I mean, there's no shortage of people that do not want to see him succeed in many levels, and some of his plans are, a little aggressive in terms of how you're going to fund those, and it's not going to be easy to do that. When those things start to fall apart and fail, that's when the rubber meets the road.
Let's shift a little bit to something that, we both have in common. That's corporate credit. So corporate credit, IG spreads have been ranging very tight ranges here. Call it 72 to right around 105. And that was, during Liberation, maybe they got to 120. For the last 5 months, we've been sitting at basically 73 to 80. However, some treasury yields have actually come in a fair amount versus the highs of the year. What's your outlook on corporate credit? What do you think about spreads right now and the risk therein?
I think to your point, they're at very aggressive levels. They're very tight. At some point, they're going to have to make a move out. And what's going to be that catalyst and when is the big question. I don't see anything happening in the immediate future. I mean, I think the economy is still robust. I think the initiatives and the lowering of interest rates and the lowering of Fed funds target is going to be a benefit to most of the corporate issuers out there in terms of their structure and how they can borrow money going forward as well. So I don't expect the spreads to gap out anytime soon. They eventually will. The timing of the matter is the question. So, we're probably buying ourselves a good 6 to 9 months before you have to really be thoughtful about it again.
So if you're buying 6 to 9 months, are you looking at trades like decompression between IG and high yield, or do you favor one asset class or the other, or are you trying to set up for something over the next year where you feel pretty comfortable?
I think it's a mix of both. I mean, I think being a little more thoughtful about where in the high yield space you want to be, but staying present in that is important, because if you can get another, 50 to 100 basis points over IG credit in high yield space for another 6 to 9 months to a year even, that's a good bonus and that's a boost. But you have to be mindful, because when the cracks do start to appear, those are going to be the credits that are going to fall first.
Yeah, we've had this market, which seems to me a little bit like when I first started 05 to 07, where you're just sitting there every day oscillating between 70 and 80, right? Credit quality is pretty high. Leverage is pretty healthy right now. And you're waiting for this moment of something to break. Right? Some people talk about, well, if the 10-year came in another 50 basis points, then as a percentage of spread, your credit risk is now a lot higher and should be, or a lot lower, and it should be higher. So maybe that's the catalyst for widening or something like that. However, what if you're at a point where inflation is stuck and the high yield market is a lot smaller now because of the private credit boom? So from an index perspective, a lot of these money managers are, quote unquote underweight just because the sheer amount of issuance out there isn't what it was or what it was intended to be. Interesting technical. My personal opinion is stuff's probably too tight, but the range is going to be tighter, right? I don't think you're going to have IG spreads blow out to 200 anytime soon or 150. 120 might sound really cheap, if it ever got there or something.
Agreed. It's kind of a recency bias the market tends to have too.
Yeah.
Suddenly you pick up an extra 40 basis points because it gaps out from 80 to 120. That looks really cheap.
Exactly. Yep. Totally agree. Okay, let's pivot to something that's, more fun for all of us to talk about, but probably not core to my being, but it is to, pretty much everybody in America. And that's, equities and whatnot. We've been on a one-way train since the lows of Liberation Day, pretty firmly. And I would say every dip, I don't know if we've had probably one dip where it lasted more than a couple of days. Sell-offs last a day. They're pretty much easily corrected. Take yesterday to today, for an example, just a quick flip-flop. Nerves are calmed almost immediately. The inflows continue. Multiples are historically high. Fear and risk seem to be growing, but yet we keep marching on. What's your take on where we are in stocks right now and the forward?
I think that's where I'm mindful of the challenges in the equity market. And when I look at valuations, the fact that you pointed out is they are very high at this point in time. The difference to me, though, is these AI companies and the AI boom that is really driving this, they actually do have some revenue behind them. So if you look back to pre-COVID days when we had higher valuations, they were built on women of prayer. So the fact that we actually do have some earnings to put behind some of those is a different dynamic. So I think they can stay higher for longer in terms of valuations, but ultimately I don't think that they can persist and there will be some sort of adjustment, some sort of a correction. And I think we even heard some news about that this morning. Other CEOs calling for such corrections down the road.
Yeah, and when he's talking about there was a summit, I believe, in Hong Kong with a bunch of leaders, and then there's another fixed income, not fixed income, summit of a bunch of money manager leaders, and they're all speaking the same tune. Stuff's overvalued. We're underweight credit. We're underweight equities. We're nervous. Something's coming.
Yep.
Now, we've been saying that for about 18 months, and we haven't had it yet. But maybe the bubble's just getting bigger. Even Michael Burry, the famous short seller from 2008, is buying puts on Palantir and Nvidia and just calling for maybe an ebb to this flow. So maybe we'll get something, maybe we won't. What people don't realize is that the passive flows are strong. This whole meme retail crowd is very supportive of the market. We never used to have this, right? The amount of individual investors trading their stocks every day has grown by about 11% in the last 3 years. And they're all buying all the stuff that some of us call garbage or some of the stuff called growth at exponential levels. Palantir is trading at 300 times forward PE, this, that, and the other, which historically, to your point, would never really happen unless you were in a real bubble. But maybe the earnings are supportive on a real forward, not even if it's not today. So it could be pretty interesting. What's the contrarian trade right now? What is something that you're looking at that we're not talking about, that I'm not thinking about, that other people should be more curious or really doing some work on?
I'm not sure how contrarian it is, but if you look back historically, the types of companies and the types of opportunities that do happen in the equity space when there's a falling interest rate environment, which we're in the middle of that right now, has been when you start looking at the smaller companies, the mid cap, the small caps, they tend to perform very well because their cost of financing goes down dramatically as a result. And they can finally start some of that expansion. And if they can play catch up to what's going on in the big caps and the mega caps, there should be some opportunity there. So I'm not sure if that's completely contrarian, but I haven't heard a lot of people talking about it. So for my sake, that's worth noting.
Yeah. So what you're saying is, listen, IWM and components there within, and then the mid cap ETF or something like that, all the components therein might have a real room to rally if we stay on this current trend.
Yep.
Yeah, I can see that.
And I think,
and it's drastically underperformed all the large caps, mega caps over the last 3-4 years.
Right. We did see a little bit of a outperformance in September.
Yeah.
So that, to me, that was like, all right, that's the first move. And there should be another move behind that and a sustained move at that.
And what if Powell holds and we sit in this stagflationary environment? Do you think that it's AI, please save us, or do we really need industrials and small caps to shelter some of the load.
I think they can kind of ride out the storm, so to speak, but I think AI will carry it through, and ultimately that's the strength of the market right now. And so I think that's where I'm more thoughtful about where we can kind of see performance.
Awesome. Listen, I really appreciate your time. I have a couple of quick hits. I like to do this in every podcast. These are things that weren't on our prep call. We haven't talked about it all. So, you're a local celebrity now. You're obviously on OpenYield's podcast, so that makes you a celebrity. But, you're often found on CNBC and Bloomberg and the like. By the way, he looks just good without makeup. I know on other networks, he gets the full treatment. Honest question, when you're walking in your own neighborhood, or let's just say you're traveling for work, do people ever come up to you and say, "Hey, Chris, I saw you on X, Y, or Z"?
It happens sometimes at the golf course. Some of the guys out on the course have seen me on Bloomberg TV or whatnot, so they do kind of point it out. And of course, on the golf course, you're made fun of about just about everything. So it's usually with a little bit of a dig at that.
Speaking of golf, what's your favorite golf course you ever played?
Wow, ever played? God, that's a tough one. I might have to go with Friars Head out of Long Island.
It's beautiful. 16, 17, 18 there, the way that ends on the water, it's about as beautiful as it gets.
Yep.
And quickly ranked like top 50 course in the whole world on a couple of recent rankings. So, a good golf course when you see one. If you're at a bar and you had one drink to order, what's the order?
I'm a little bit of, I would say, an old-fashioned snob. So I want a really good old-fashioned.
Like an old-fashioned.
Got to have the big ice. You got to have the right cherries. You got to do it right with the right amount of garnish, but old school.
One big cube.
Exactly.
Let it sit there and percolate. And then finally, S&P closed 2026. Make me 100-point market.
End of 2026?
End of 2026.
Okay. I'm going to have to go with 7,700.
7,700. You heard it here first. That would be about, 12% increase or thereabouts, something like that.
From right
Quick
now.
math from where we are today.
Yep.
Yeah, right about there. Well, I appreciate your time. Again, this is CIO of SWBC, Chris Brigati. Thanks for stopping by. We really appreciate your time.
Glad to be here.
All right. Thank you.
Thank you.